Have you ever looked at the stock market and thought, isn't this just gambling with extra steps? Maybe you've hesitated to invest because everyone says it's risky, or maybe you believe you need a finance degree or insider knowledge to even get started. If any of that sounds familiar, this summary is for you. Today we're diving into One Up on Wall Street by Peter Lynch, one of the most successful mutual fund managers in history. But don't worry, this isn't a book just for Wall Street professionals or finance geeks. It's a guide for everyday people who want to grow their money smartly, even if they've never studied a single stock chart. Think about it. Have you ever discovered a great product before everyone else did? A favorite restaurant, a new gadget, or a local brand that suddenly blew up? That right there, according to Peter Lynch, is your investing edge. And that's what makes this book so powerful. It teaches you how to recognize those everyday opportunities and turn them into smart investments. Lynch doesn't just throw around theories. He shares real-life examples, personal experiences, and practical advice that anyone, yes, even a complete beginner, can use. Through this summary, you'll get a front-row seat to his thought process and learn when, where, and how to invest without being overwhelmed. So stay with us till the end, because by the time we're done, you might just realize that the stock market isn't a gamble. It's a game you're already equipped to win. Let's begin. The making of a stock picker. Before investing in stocks, most people hesitate, often overthinking 100 times. And if someone has no background in finance, they tend to stay miles away from the stock market, assuming it's too complicated or too risky. But in this chapter, Peter Lynch breaks that myth wide open. He shows us that to succeed in the stock market, you don't need to be a financial expert. In fact, even if you've studied history or philosophy all your life, you can still become a successful investor. If you've ever believed that a degree in finance is necessary to invest, let Peter correct that thought. He himself had no formal financial background, and yet he went on to become one of the best-performing mutual fund managers the world has ever seen. Peter Lynch was born on January 19, 1944. His mother was the youngest among her 7 siblings. His family lived through the era of the Great Depression, a time that left deep scars on their financial mindset. Because of that, they never trusted the stock market. In fact, only one person in his family had ever dared to invest, and that was his grandfather. His grandfather had once invested in a company called City Service, thinking it was a water utility firm, but later he discovered it was actually an oil company. Nervous and unsure, he sold all his shares quickly. Ironically, shortly after selling, the price of City Service stock skyrocketed, going up by 50 times. That one missed opportunity became symbolic of how fear and misinformation kept many Americans, especially in the 1950s, away from the stock market. Most believed it was just a high-stakes gamble where you were more likely to lose than gain. In Peter's own household, stock investing was never a topic of conversation. His family had always kept a safe distance from it. When he was just 10 years old, his father tragically passed away from brain cancer. Suddenly, the entire responsibility of the household fell on his mother's shoulders, and to support her, Peter started looking for ways to earn on his own. That's how he ended up taking a job as a caddy, a person who carries golf bags and assists players at the golf course. At that time, being a caddy was a big deal for him. He was earning more than kids who sold newspapers, and, more importantly, it gave him rare access to high-profile people, CEOs, executives, even a president. As he worked for them, he listened closely and observed carefully. Many of these men were investing in the stock market and making impressive profits. That was the moment Peter's curiosity sparked. Maybe the stock market wasn't as dangerous as it seemed. Throughout high school, he continued working as a caddy year-round to support his expenses. He found himself drawn more toward the arts than to science. He had no interest in subjects like accounting, mathematics, or business. In fact, he believed that investing wasn't a science, it was an art, and for that, he trusted his instincts and observations more than textbooks. In 1963, he got his first chance to invest in a stock. He bought shares in a company called Flying Tiger Airlines, priced at just $7 per share. But he didn't choose this company randomly. He had read an article in the newspaper predicting a bright future for freight companies, businesses that transport goods. What the article didn't mention, however, was that a major war was underway in Vietnam, and the demand for cargo transport across the Pacific Ocean had surged. Whether it was luck or intuition, that investment paid off, and Peter made a profit. While studying at Boston College, he landed a summer job at Fidelity Investments in New York. He had no prior experience in finance. His role was simple: research companies and write reports. But that small role became his entry point into the investment world. When he returned for his second year at Wharton, he had a realization. Everything he had learned in college so far was hardly useful in real life. He had studied statistics and advanced calculus, but those concepts didn't help him make smart investment decisions. When he compared his professors at Wharton to the professionals at Fidelity, he noticed a striking difference. Theoretical knowledge didn't always translate to practical success. That insight changed everything for him. At that point, his portfolio was just starting to grow. He remembers a time when all he had in savings was $150. But that didn't stop him. He was learning through experience. One investment, one observation, one mistake at a time. So if you still believe you need qualifications or expert advice to begin investing, Peter Lynch is here to tell you otherwise. You're not underqualified. You don't need a fancy degree. All you need is curiosity, observation, and the willingness to learn from the world around you. The Wall Street oxymorons. Imagine this. A complete beginner in the stock market outperforms a seasoned professional. Sounds impossible, right? But Peter Lynch argues that it happens more often than you think. In this chapter, he explains why the term professional investing is, in his view, an oxymoron. Two contradictory words placed together like deafening silence. While the world believes that investing should be left to the experts, Lynch challenges that belief head-on. In fact, he suggests that beginners often have a surprising advantage over professionals. Why? Because professionals are bound by rules, expectations, and reputations, while you, as an individual investors are free to explore, experiment, and think independently. New investors, however, are often told to be cautious, to wait until a stock is popular, endorsed, or recommended by large institutions. But by the time that happens, the real opportunity is usually gone. Lynch calls this behavior the street lag. When you wait for Wall Street's stamp of approval before acting and end up missing the biggest gains, professional fund managers don't chase potentially rewarding opportunities early on. Instead, they tend to play it safe. They avoid lesser-known stocks, not because those companies lack promise, but because recommending a stock that fails could cost them their job. So, they stick with household names like IBM. Even if IBM stock drops, no one questions their judgment. After all, it's IBM. But if they suggest a small, unfamiliar company that flops, their career could be on the line. That's why many professionals avoid risk, not for your benefit, but to protect themselves. Now, think about this. You don't have a boss monitoring your decisions. You're not managing someone else's money. You don't have to justify your choices in board meetings. That independence is your superpower. You can take bold risks. You can invest in smaller, lesser-known companies long before they make headlines. You don't need to spread your money across dozens of stocks like institutions do. You can focus on just one or two if you believe in them. Lynch also shares something interesting about how fund managers operate. Let's say two clients from the same bank play golf together. If one tells the other that his portfolio went up by 40% while the others only grew 20%, guess what happens next? The one with the lower returns might pull his money out of the fund entirely. To avoid this, banks often give clients the same set of stocks, just shuffled a little differently, so no one feels left out or underperformed. But you're not bound by such concerns. You're free to think differently, to act on your instincts. If you notice a restaurant always packed with people, or see your friends raving about a new brand, they might just be signals of a rising stock. These everyday observations are things professionals miss. Why? Because they sit in offices relying on quarterly reports and analyst notes. They don't see what's trending in the real world until it's too late. That's your advantage. So don't let the word professional intimidate you. When it comes to investing, your everyday awareness might just beat a Wall Street degree. Trust what you see, trust what you know, and most importantly, trust that you don't need a title to be a great investor. Is this gambling or what? Many people hesitate to invest in the stock market because they fear it's just another form of gambling. The ups and downs feel unpredictable and the risks seem overwhelming. But is that really the case? In this chapter, Peter Lynch helps us understand the true nature of stock investing by comparing it not only with bonds, but also with a game of stud poker. A clever metaphor that brings clarity to this complex topic. Whenever the stock market dips, people rush to buy bonds thinking they're the safer choice. And while bonds do carry less volatility, they also come with limitations. Think of bonds like loans. You lend money to a company or government and receive interest in return. Over the last 2 decades, bonds have gained popularity, but when you compare their returns to those from stocks, the difference is stark. Investing in stocks means becoming a part owner of a company. You're not just lending money, you're buying a piece of the business. As the company grows and thrives, so does your investment. Whether you invest in a global brand like McDonald's or a small, promising startup, you're aligning your future with the company's success. In contrast, bondholders are simply lenders. They get their fixed interest regardless of how well the business performs, but they miss out on the potential upside. Of course, stocks carry more risk. There are no guaranteed profits, but Lynch argues that it's not the risk that makes stocks seem like gambling. It's poor timing and uninformed choices. People often lose money when they invest in the wrong stocks at the wrong time and then blame the market instead of their decisions. The truth is, even bonds aren't entirely safe. Interest rates can drop so low that the returns barely beat inflation, or you may be forced to sell bonds at a discount, losing money in the process. Before investing in any company, Lynch advises asking a few basic but essential questions. Let the answers guide your decision. Stock investing, he says, is like playing poker. In the beginning, you have limited information. You only know your own cards. But as the game unfolds and more cards are revealed, the picture becomes clearer. Similarly, with research and patience, your confidence as an investor grows, passing the mirror test. Before jumping into the stock market, Peter Lynch encourages every potential investor to take a simple self-assessment, what he calls the mirror test. These 3 questions are designed to ground you, reduce impulsive decisions, and make sure your investment choices align with your real-life priorities. Question 1. Do I own my own home? Lynch believes that buying a home should be your first investment. It's a foundational asset, a primary investment that provides both security and stability. But even then, be just as cautious with buying a home as you would with buying stocks. Do your homework. Question 2. Do I need this money in the near future? If you're saving for something important, like your child's education in a year or 2, don't put that money in stocks. The market can be unpredictable in the short term, and you should only invest money you can afford to leave untouched. Stocks are for long-term goals, not immediate needs. Question 3. Am I personally equipped to succeed in the stock market? This question isn't about financial knowledge, it's about personal traits. Are you patient? Can you tolerate setbacks without panicking? Do you have common sense, flexibility, and the discipline to stick with your investments over time? If you do, you're already ahead of many so-called professionals. But there's one more thing. Never rely on gut feelings. Always make decisions based on facts, not emotions. Lynch explains that even average investors often fall into an emotional roller coaster. First comes concern, worrying the stock might drop. Then complacency, buying stocks at high prices, thinking they'll keep going up. And finally, capitulation, panic selling when the stock dips, locking in losses that could have been avoided. Ironically, many investors proudly call themselves long-term investors until the market turns against them. The moment prices fall, they become part of the short-term crowd, selling out of fear and abandoning their original plan. The lesson is simple but powerful. Successful investing is not about perfect timing or insider knowledge. It's about self-awareness, discipline, and the ability to stay calm when others panic. So before you invest, stand in front of the mirror and ask yourself these 3 questions honestly. Your reflection might just save you from costly mistakes. Is this a good market? Please don't ask, how's the market these days? Is this the right time to invest? Should I wait or jump in now? These are the questions Peter Lynch hears all the time, and his answer is simple. No one can predict the market, not even the experts. Trying to guess when prices will go up or down is like reading tea leaves. It might sound smart, but it rarely leads to consistent success. In this chapter, Lynch explains why attempting to time the market is a waste of time. He encourages investors to avoid relying on past experiences to predict the future. Just because something happened once doesn't mean it will happen again. Human nature, however, tends to fall into that trap. We try to forecast the future based on patterns we've seen before. But in the world of investing, history doesn't always repeat itself. To illustrate this point, Lynch shares an example from Mayan mythology. According to ancient beliefs, the world had ended 4 times already, each time in a different way. The Mayans tried to protect themselves from future disasters based on what had happened before. After a flood, they moved to the mountains and built homes in trees. Then came destruction by fire, so they prepared for that. But every time their preparations were based on the last disaster, not the next one, their protection was always one step behind. It's the same with financial markets. You can prepare for the last crash, but it won't help you with the next one. The truth is, no one, no matter how smart or experienced, can predict exactly when the market will rise or fall. If even seasoned professionals can't forecast accurately, how can beginners expect to? That's where Lynch introduces his entertaining and insightful cocktail party theory. Picture this: you're at a cocktail party. Guests from various professions are sipping their drinks and mingling. The conversation flows from teeth problems with the dentist to holiday plans with friends. Stage 1. No one cares about the stock market. No one approaches the mutual fund manager. He's standing alone while everyone talks to the dentist. This is the stage when the market is likely to rise because no one's paying attention. Stage 2. A few people casually ask the mutual fund manager about investing but quickly return to their other conversations. At this stage, the market has started to gain momentum, possibly up by 15%. Stage 3. Now everyone is circling the mutual fund manager, eager to hear which stocks they should buy. Even the dentist wants investing tips. The market is likely up 30% by now, and excitement is in the air. Stage 4. Suddenly the tables turn. People aren't just asking for advice, they're giving it. Everyone is confidently telling the fund manager which stocks to buy. The dentist is now playing the role of financial guru. This is the danger zone. The market is overheated and likely near its peak, ready to fall. The cocktail party is a metaphor for public sentiment. When no one is talking about stocks, that's usually the best time to invest. But when everyone is an expert, it's time to be cautious. So instead of asking, "Is this a good time to invest?" ask better questions. Is this a good company? Do I understand the business? Am I willing to hold this investment for the long term? Because markets will go up and down, that's their nature. But solid investments made with logic and patience will stand the test of time. Stalking the 10-bagger. And I've got it. What is it? If you've ever asked yourself, where should I invest? Peter Lynch has a simple answer. Look around you. The best investment opportunities might already be in your home, your workplace, or the shopping mall you visit every weekend. The truth is, the average person gets at least 2 or 3 great investment chances every year. The real challenge is recognizing the right one at the right time. This, according to Lynch, is the first step in smart investing, paying attention to what you already know. You don't need to be a CEO, a financial analyst, or even have any formal training to understand what makes a good investment. Whether you're a teacher, a geologist, or someone working a regular job, you already have the tools to spot potential. Invest in what you use, what you love, and what you believe in. If you've used a product and think it's brilliant, chances are others feel the same. And that gives you a natural edge. As a consumer, you're often the first to sense a product's market potential long before analysts pick up on it. But that doesn't mean you should rush to buy the company's stock right away. Step 2 is research. Buying a stock without research is like playing poker without looking at your cards. Surprisingly, people often put more thought into buying a new sofa than they do into buying stocks. That needs to change. You need to understand how much a product contributes to the company's overall profits, not just how well it sells. For example, take Pampers. It's a well-known product that's been around since the 1970s. The packaging clearly states it's made by Procter & Gamble, so you might think buying P&G stock is a no-brainer. But with a little research, you discover that Pampers contributes only a small fraction to the company's overall earnings. So while the product might be successful, it doesn't mean it's a major growth driver for the company. That's why it's not just about how good a product is, but how significant it is to the company's bottom line. Another key consideration is company size. Big established corporations like Coca-Cola are unlikely to provide explosive returns. Why? Because they're already at the top. The real opportunity often lies in smaller companies, the ones that haven't peaked yet. These are the potential 10-baggers, stocks that can grow tenfold in value. To help you identify where to focus your investments, Lynch categorizes companies into 6 types. 1. Slow growers. These are mature, established companies that were once fast growers but have now plateaued. A common example is electric utility companies. They grow slowly, usually just slightly faster than the national economy, and their stock returns are modest. Second, stalwarts. These lie between slow growers and fast growers. They're large, reliable companies that can deliver steady, moderate profits. Think of Coca-Cola. If you invest in a stalwart at the right time, it can give you decent returns with lower risk. 3. Fast growers. These are the exciting ones. Companies that can potentially give you returns of 100%, 200% or more. They dominate niche markets and scale rapidly. Examples include Taco Bell in fast food, Walmart in retail. These companies often have a local monopoly or a unique business model that sets them apart. However, it's crucial to observe how these companies perform during tough times, like economic recessions. That helps you decide how long to hold their stocks and when to exit. 1. Cyclicals. These are companies whose profits and stock prices rise and fall in cycles. Think airlines or chemical companies. Their success often depends on external factors, like raw material prices or government regulations. Timing is everything with cyclicals. Get in too late or exit too early, and you could lose. Second, turnarounds. These are companies that have fallen on hard times, maybe due to debt mismanagement or shrinking markets. Investing in turnarounds is risky, but if the company recovers, the returns can be substantial. Still, if the company continues to struggle with high debt or inflated PE ratios, it's safer to sell and move on. 3. Asset plays. These are hidden gems, companies sitting on valuable assets that the market hasn't fully recognized yet. It could be real estate, patents, or even a strong brand name. Big investors often overlook these, but smart individual investors can spot them early and benefit hugely. What's important to remember is that a company doesn't always stay in the same category forever. A fast grower today might become a stalwart tomorrow. Your job is to not only research a stock thoroughly, but to also classify it into one of these 6 categories. That's step 3 of your investment method, categorization. Once you've spotted a promising stock and done your homework, placing it into the right category will help guide your expectations, your holding strategy, and ultimately your success as an investor. The perfect stock. What a deal. And stocks I'd avoid. Now that you've learned how to categorize companies, it's time to take the next step. Figuring out which ones are actually worth investing in and which ones you should completely avoid. Think of this as completing the story. Categorization gives you a rough sketch, but understanding how a company grows its earnings, that's what completes the picture. That brings us to step 4 in your investment method, evaluating earnings growth potential. Peter Lynch explains that companies typically follow one or more of these 5 strategies to boost their earnings. 1. Cutting costs. This is a common move in highly competitive markets. Companies reduce expenses to stay ahead of rivals, allowing them to generate more profit without raising prices. 2. Raising prices. When a product is already selling well, companies may raise prices to increase profits. If consumers see value, they're often willing to pay more. This is a simple but powerful profit-boosting tactic. 3. Expanding into new markets. Companies often launch new products or services or target different customer segments. By broadening their reach, they open up new streams of revenue. 4. Selling more in existing markets. This involves increasing market share where the company already operates. Strategies include attracting new customers, encouraging existing ones to buy more, or even pulling customers away from competitors. 5. Reviving struggling units. Sometimes companies shut down underperforming divisions or rethink outdated strategies. Reallocating resources or refocusing efforts can breathe new life into dormant parts of the business. Lynch makes an important point here. Boring companies with boring names often make the best investments. Imagine a stock called Bob Evans Farms. Not exactly glamorous, but such companies tend to fly under the radar, offering value that the market hasn't priced in yet. On the other hand, flashy companies with trendy names often crash as fast as they rise. For example, a company that makes bottle caps might sound dull. You'll never see it featured on the front page of a business magazine, but if institutional investors are ignoring it, it might be your golden opportunity. In fact, investing in low-growth industries is sometimes smarter than chasing high-growth sectors. That's because when an industry is booming, it attracts a flood of new players, which increases competition and drives down prices. High-growth industries can be dangerous, not because of the industry itself, but because of the hype that surrounds them. Lynch also advises paying attention to companies that use technology effectively rather than those trying to invent it. Tech companies are often in a constant battle to innovate, and fierce competition keeps their profit margins thin. But companies that simply use technology to run operations more efficiently tend to generate consistent profits. Another green flag is when company insiders, like executives and founders, own large amounts of the stock. This usually means they believe in their business and are invested in its long-term success. If they're confident enough to keep their money in, it's a good sign. Now, let's talk about the stocks you should avoid. 1. The hottest stock in town. If everyone is talking about it, you've probably missed the boat. The hottest stocks often rise fast, but they can fall even faster. What looks like quick profit can quickly turn into a big loss. 2. The next big thing. Be cautious of companies that are being hyped as the next Intel or the next McDonald's. Replicating the success of giants is extremely rare. These comparisons are often more marketing than reality. 3. Whisper stocks and long shots. Sometimes people recommend stocks like they're sharing a secret, adding a personal touch to make it sound exclusive. These whisper stocks often lack real fundamentals and are based on speculation, not substance. 4. Fancy names, no substance. A flashy name might catch your eye, but don't let it distract you. Often these names are chosen specifically to attract attention and create buzz. Always look beyond the branding, because a great name doesn't guarantee great performance. In the end, the best stock may not be the most exciting one, but it's the one with real potential, solid earnings, and a business model you understand. Earnings. 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 The 2-minute drill and getting the facts. Before investing your hard-earned money, there's one crucial question you must ask. Will this company be more valuable tomorrow than it is today? That's the heart of investing. Whether a company is likely to grow its earnings and assets over time. And your decision should always be based on solid facts, not hype or hope. Earnings and assets determine how much investors are willing to pay for a stock. A key metric here is the PE ratio, the price-to-earnings ratio, which helps you evaluate whether a stock is overpriced, underpriced, or fairly valued. It's calculated by dividing the current stock price by the company's earnings from the last 12 months. Of course, we can't predict the future perfectly, but what you can do is examine a company's plan for growth. H. How does it intend to increase earnings? Are those plans working? Once you know this, you can monitor its performance over time and decide whether to buy, hold, or move on. Start by placing the company into one of the 6 categories we discussed earlier: slow grower, stalwart, fast grower, cyclical, turnaround, or asset play. Then, based on that category, evaluate the company's health. Slow growers. Only invest if they regularly pay dividends and are steadily increasing earnings, even during tough times like recessions. Cyclicals. Look at trends. Has the company's sales increased consistently over the past few years? Asset plays. Identify what assets the company owns and what those assets are really worth. Turnarounds. Check whether the company's recovery plan is effective and if its earnings are improving. Stalwarts. Use the PE ratio to determine if the stock is worth buying. Fast growers. Focus on how quickly the company can continue expanding. What's fueling their growth and can it be sustained? Still unsure? Call the company. Most honest companies will provide straightforward answers because they know the truth will eventually come out in earnings reports. As a shareholder, you have the right to ask questions and even visit their headquarters. Use their products, go to their stores, and talk to their customers. Ground-level research can reveal truths that financial statements sometimes miss. Some famous numbers, rechecking the story, and the final checklist. You've found a stock. You've done the research. You've placed it in the right category and assessed its earnings. But before you invest, there's one final step. Check the numbers. Numbers are more powerful than rumors. They reveal the true health of a company, where it stands today, and where it might be headed. Here are some of the key indicators Peter Lynch recommends reviewing. 1. Percentage of sales. This tells you how much a product contributes to the company's revenue. If a product sells well and represents a large portion of sales, it's likely driving profits too. Second, PE ratio, price to earnings. As mentioned, this ratio helps you determine whether a stock is undervalued or overvalued. Compare the stock's PE with the average PE of its industry. A low PE could signal a bargain, but only if the company is fundamentally strong. Third, industry PE comparison. Every sector has its own average PE. If your company's PE is below the industry average, it might be undervalued, but be cautious. Sometimes a low PE reflects deeper problems. Use it as a clue, not a conclusion. Cash position. How much cash does the company have per share? Can it cover its debts and obligations? A healthy cash position means the company can survive downturns without scrambling for funding. 5. Debt factor. Avoid companies where debt exceeds equity. High debt can sink a company, especially during tough economic times. A debt-free or low-debt company is far more resilient. 6. Dividends. Companies that pay regular dividends, even during recessions, are typically more stable and profitable than those that don't. A consistent dividend is a good sign of confidence and cash flow. 7. Inventory. If a company's inventory keeps increasing but sales don't, that's a red flag. It could mean products aren't selling or management is misjudging demand. And remember, never stop checking the company's progress. Keep visiting stores, talk to customers, review earnings reports. A smart investor never invests and forgets. They observe, evaluate, and adapt. Finally, here's Peter Lynch's golden advice. Consider small companies. They often deliver the biggest growth. Avoid jumping on the bandwagon. If everyone's buying it, you may be too late. A company with zero debt will never go bankrupt. Trust companies that buy back their own shares. It shows management believes in the business, and most importantly, be patient. Take your time. Do your research. Let facts, not emotions, guide your decisions. In the end, great investing isn't about perfect timing. It's about knowing what you own, why you own it, and sticking with it until the story changes. The long-term view. Now that you've researched, categorized, and evaluated companies, it's time to actually build your portfolio, the collection of stocks you'll invest in. This is step 6 of your investment journey. But before diving in, let's clear something up. There's no perfect time to invest. The market will always fluctuate, and no one can predict its exact moves. However, by staying alert and informed, you can recognize good opportunities and, more importantly, avoid bad ones. A great sign that a stock is worth buying is when its PE ratio is lower than the industry average. A high PE suggests investors expect future earnings growth, but it might also mean the stock is overvalued right now. A low PE could indicate the stock is undervalued, but don't just rely on this number alone. Always check additional factors like inventory levels, cash flow, cash position, and debt before making a decision. Expecting an annual return of 25 to 30% from the stock market every year is unrealistic. Sure, you might hit those numbers in some years, but others will fall short. Instead of chasing extreme gains, focus on consistent, informed investing. Diversification matters. The more stocks you own, the more chances you have for at least one to deliver extraordinary returns. With a variety of stocks, you can also rotate your money strategically depending on performance. Distribute your investments across different categories. Slow growers are lower risk but also offer modest returns. For example, Coca-Cola may sound like a reliable performer, but you likely won't see massive profits. Asset plays, on the other hand, offer low risk and high potential gains. Cyclicals can go either way. They may carry low or high risk, depending on timing and external factors. Fast growers offer big rewards, but they come with big risks too. The best time to invest is when you're confident in the stocks you've identified. However, historically, stocks often dip between October and December during the holiday season, making it a potentially good buying window. But remember, you can't hold on to stocks forever. If a company is no longer performing or generating earnings, there's no reason to stay invested. You're in the market to make money, not to stay loyal to underperforming stocks. If your investment is slipping into loss without signs of recovery, it's time to consider selling. That brings us to step 8, knowing when to sell. There's no single rule for when to sell a stock, but here are some key guidelines. Slow growers. Sell when the stock has appreciated by 30 to 50%. Stalwarts. Sell when the PE ratio climbs significantly above its normal range. Cyclicals. Sell at the end of the cycle, especially if external signs or internal performance start weakening. Fast growers. Sell if the PE ratio skyrockets without justification. CE begins to slow. Turnarounds sell once the company has successfully turned around and the original problems are resolved. Asset plays hold as long as the company stays out of debt. If it's financially sound, these can be long-term holds. You should also watch for market declines. They often offer great buying opportunities, but be careful not to buy just because a stock looks cheap. If the company isn't doing well today, there's no guarantee it will do better tomorrow. Ultimately, the stock market is a place where you must keep your mind open to new ideas. The key to long-term success isn't in guessing the market. It's in choosing solid companies, staying patient, and being smart about when to hold and when to let go. Conclusion: One Up on Wall Street isn't just a book about the stock market. It's a guide that empowers everyday people to think like investors. Through his personal stories, sharp observations, and timeless strategies, Peter Lynch shares a lifetime of investing wisdom that's both practical and inspiring. Whether you're a beginner taking your first steps into the world of stocks or someone looking to sharpen your investment strategy, this book offers valuable insights for everyone. Lynch's core message is simple. You don't need to be a Wall Street insider to succeed. You just need to pay attention, think logically, and do your homework. Throughout this summary, you've learned how to categorize companies based on their growth patterns, spot promising stocks in your everyday surroundings, evaluate earnings, risk factors, and financial indicators, avoid common investing traps and hype-driven decisions. Know when to buy, hold, or sell based on facts, not emotions. Most importantly, this book encourages you to take control of your financial future by trusting your instincts, applying research, and making thoughtful decisions that suit your own financial situation and risk tolerance. Investing isn't about chasing trends. It's about understanding value, staying patient, and thinking long-term. And now, with the lessons from One Up on Wall Street in hand, you're better prepared to navigate the market, grow your portfolio, and make smarter choices with confidence.